Welcome to AllGen's Market Update. My name is Jason Martin. Today is July 15th, 2020. I wanted to bring you guys up to speed about what's going on in the market. So we're going to cover a few topics today. How the U.S. markets have been somewhat range bound, as have world death rates, world deaths for the coronavirus. Then we're going to talk a little bit about how commodities are strengthening as the U.S. dollar is weakening. I'm going to look at some emerging markets, how they're starting to look a little bit more attractive, and then also check out the U.S. bonds and how they're still at an all-time low in terms of yield. So let's hop right in. First, gauging here the worldwide coronavirus deaths per day. You know, we focus a lot, we mentioned this in the past, on the actual daily deaths as opposed to the cases. The cases are going to, it's obviously a lot of what the news focuses on, and it shows that they have increased a lot, but as I've mentioned in the past, they're also testing 10, sometimes 20 times more than they used to test, so they're finding a lot more. It doesn't mean that there are a lot more compared to what there was, but it just means that they're discovering a lot more. But the death rate is a more accurate metric of how we're progressing in this pandemic. So as you can see here, in March when it started getting really bad, and death rate got up to about 7,500 deaths per day. This is worldwide, and then it started to decline, and now we've been kind of range bound, just going sideways for like the last month or so. So, which is interesting because we flip to this next chart, similar to this is the S&P 500. You can see how the S&P 500, you took the big drop when deaths went up a lot in late February, early March, had the big rally as it started to reverse, and then now the U.S. stock market's also been range bound, just kind of going sideways here over the last little bit more than a month. So obviously we're keeping close eye to see which way both the daily deaths break out from that range and which way the stock market breaks out from the range. So that's something we have to constantly monitor and be prepared to shift our portfolios based off of that. So shifting here to commodities. Commodities have really started to make a good progress in terms of some of them close to all-time highs and some of them changing their trend. So what we're looking at here is gold. And gold, this is actually chart goes back 40 years here. You can see its all-time high, which was on August 22nd, 2011, $1,917 an ounce. And then you fast forward to where we're at now. You can see as of yesterday, it was at 1803. So gold's getting close to testing its all-time high, and we'll see if it's able to break above that. Along with gold, this is a chart that we're looking at here is copper. Copper is a lot more cyclical, and what that means is copper is used a lot in electronics and used to be used and still is to a certain degree in plumbing and a lot of different industrial applications. And so copper is a good barometer of what the overall economy is doing. And if copper is going up, it tends to be good for the economy. If copper is going down, it's an indicator that the economy is weak. So you can see here, it's been trending down ever since 2011, but it's getting to the point right now where it looks like it could potentially break to the upside. If that happens, and from a short-term point of view, if I was to draw a line right here, it actually has broken that trend. But from a long-term point of view, it's right at resistance. If it's able to break above that, that could be a sign that the economy is starting to strengthen. It's also a leading indicator, so it usually happens prior to the economy actually starting to strengthen. So it's a good chart to follow to kind of get it, to understand what potentially could happen in the future. So looking at the next chart here, we're looking at silver, another commodity. Now, silver is considered a precious metal, but it's kind of similar to copper. It is a little bit more industrial and used in a lot more industrial applications. But you can see here, since 2011, it's been in a downtrend. And then if you draw a trend line along these highs right here, just recently it's broken out for that trend line. So it appears to be changing trends and starting in a new upward trend. Again, that would be showing strength in commodities in general. So the other reason commodities, and I think this is probably the bigger reason commodities are starting to go up, is that usually commodities and hard assets tend to go up as the US dollar weakens. And so right now you can see this is the chart of the US dollar. It was going down from 2000 really to 2008, and then it started an uptrend since 2008. And now you're starting to see where it hasn't broken down yet, but it's at a pretty critical point where if it was to break down below these two trend lines that I've drawn here, if it was to break below that, then it could be changing trends and the dollar could be weakening. As we kind of gauge what's going on in the world and what's going on from a fiscal and a monetary policy here in the United States, the United States and the Federal Reserve has printed a lot of money, a lot of quantitative easing, and they've also lowered interest rates really low. Both of those things tend to weaken your currency. So, that's something that we're watching closely to see if the dollar does break down. That could make things like commodities and other assets I'm going to talk about in a little bit appear a lot more or actually become a lot more attractive. So what we're looking at here is a comparison between the S&P 500 and emerging markets. Okay, so the way this chart works is if this line is going down, it means emerging markets are outperforming the S&P 500, and then if this chart is going up, it means the S&P 500 or US stocks are outperforming emerging market stocks. So you can see from 2000 through 2011, emerging markets did significantly better than the US stock market represented by the S&P 500. But since 2011, the US stocks have done significantly better than emerging markets. And a lot of people over the last 10 years have say, just buy the S&P 500. You're going to do really well. You're going to beat most portfolios. And for the last 10 years, that has been true. But, the market is kind of like a pendulum. It swings one way to the other way. And in the prior 10 years, 2000 through kind of 2010-11 time frame, emerging markets did way better than the S&P 500. And now you've had the S&P doing a lot better than emerging markets. And you could see that pendulum swing back again, where emerging markets start to outperform. From a short-term basis, the trend has changed, but the more significant line to follow is this longer-term trend line. If it was to break below that, that could show a change in the trend of direction. This is also influenced by the US dollar. So if the dollar continues to weaken, you'll probably see both international, but especially emerging markets do significantly better. Also, emerging markets tend to have a lot of commodities inside their countries, a lot of natural resources, and a lot of companies that produce those. So that tends to do better as well when the dollar is weakening. So something we're closely monitoring. This is the short-term point of view that I was talking about, where you can see here, same chart, S&P 500, compared to the emerging markets. And if this line is going down, emerging markets are outperforming. If it's going up, the S&P 500 is performing. So you can see over the last 2 years, from a short-term point of view, the emerging markets have, it's changed directions where the emerging markets are looking like they're starting to outperform. So this is a chart that compares developed international markets, which would be like most countries in Europe, and Japan, the more developed international companies versus emerging markets. And you can see here recently, well, let me explain how the chart works. So if this line is going down, emerging markets are outperforming developed markets, where if this line is going up, developed markets are outperforming emerging markets. And you can see here, this trend line right here has been broke to the downside, which means emerging markets are starting to outperform developed markets. So this chart, shifting gears here, looking at bonds, and this is the 10-year Treasury yield. Okay, so bond prices trade inversely to bond yields, so or interest rates. So if interest rates are down, bond prices are up. So this is looking at the actual yield of the 10-year Treasury. As you can see here, it's near, it's pretty much an all-time low. Right there at that all-time low, which means bond prices are at near an all-time high. And that's a little bit range-bound as well. And I think you're going to see it kind of go back and forth between these this point, basically 0.6% to 0.9%. But something that we want to monitor over time, depending if it breaks one way or the other, we may need to shift the portfolio as well. So in summary, we're shifting more securities in our portfolio that perform better in a weaker dollar environment. So we've been shifting more towards gold. We've been telling you that in the last few updates. We've also been shifting a little bit more towards emerging markets, and both of those tend to do better in a weaker dollar environment. We also continue preparing for a second wave of COVID-19 as we enter the fall. It's not a for sure thing, but we are leaning to, it looks more likely that there will be a second wave, and with our investment philosophy, we always try to manage risk first, so we're preparing for that to happen. But it's something that we have to constantly monitor, because if a vaccine comes out or if something happens where it gives the market a lot more confidence, the market could run. So we have to be prepared to go either direction there, but right now we're leaning to being more on the defensive side, just in case a second wave does come. The way we're doing that is maintaining a defensive posture by holding less stocks, and the stocks that we do own have more emphasis on defensive type of stocks that tend to do better during bad economic environments, holding more U.S. Treasury bonds and safer bonds, and then holding some gold, which is also considered a safe haven. So I hope this helps, and hope everyone's doing well and staying healthy, and look to talk to you soon. If you haven't done so already, click here to subscribe. We frequently upload market update videos on the coronavirus, provide financial planning tips, and relevant personal finance topics on our channel.